In this week's update, it's difficult to be caught out if you have someone diligently watching. And equity markets set new highs. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, look, as a consequence of events that have happened in the last few months and various conversations that I've had with investors, I want to make just a really clear point today, because it strikes me very clearly that a lot of investors are unnecessarily stressing about what the market does do in the short term, what it may do in the next 3 months, next 6 months, and it all just leads to poor investing decisions. There's a very simple way to think about the market and respond to the market. So that's the message out of the video today. So let's put things in perspective. Events like COVID in 2020 or the Trump tariffs just recently are relatively short-term events. And they hurt if you allow them to, but the impacts are likely to be temporary. And I would classify the impacts as less than, say, 3 to 6 months max. Now, if you're a long-term investor, then really those sort of events, if you own quality stocks, those sort of events shouldn't worry you in the slightest. But the fact is that they do. They severely worry a lot of investors, and that anxiety causes investors to do all sorts of dumb things, to sell stocks they shouldn't, to perhaps buy stocks that they shouldn't at the wrong time. It just leads to really poor decision making. And yet the impacts, when you stand back and you look over time, are really neither here nor there over a period of 5 or 10 years. So it's all unnecessary. The severe impact is on short-term traders. Events like we saw this year or we saw in 2020, they can hurt short-term traders dramatically, but I'm speaking here to longer-term investors, which is what most people are. So the message is, with these sort of events, most investors should be absolutely fine and really have nothing to worry about. So this is more a battle of the brain than anything else. So why the stress and all the agonising? So I want to give you a perspective on the fact that we nearly always get early warning signs of significant market events, so where the impacts are far longer. The big events that you want to try and avoid are where the impacts last 6 months and longer. And they're events like we saw with the GFC in 2008, and they cause us to question and doubt what we're doing as investors. And it's just not required, because it leads to generally unfortunate decisions. So 2008, there were lots of early warning signals well in advance. You just had to be watching and understand what it was that you were watching. And also in 2022, where the US tech stocks went down for 12 months and went down quite significantly. And that put a drag on the rest of the markets as well. So whilst there wasn't the big, often discussed trigger like we saw with the GFC, 2022 was a period of time that would have caused investors, and justifiably so, some distress. So we're going to look at those two instances. So all you need to get through these periods and to be far more productive investors is you've got to be paying attention to a few simple things, which I highlight every Sunday. Be prepared to acknowledge what you're seeing. Don't get caught at the party at 5 past midnight, and take some action on that. And that's really all you need to do. And if you can do those things, then your investing results are going to be far, far better. So let me go and examine those couple of periods. So I want to focus on the NASDAQ composite, because that is probably giving us the most accurate information about what growth stocks are doing. So my message is, we can ride through events where the impacts are less than 3 to 6 months, but we need to be able to distinguish what is a shorter term transient event to something that is more structurally based, that is based more on the markets or the economy having got completely off track. And that was certainly the case with the GFC. And in the case of 2022, well, tech stocks in America had just got way ahead of themselves. coming out of the post-COVID crash, the market just went absolutely stupid and pushed those prices up too high. So there was actually a structural valuation problem. So they're the ones that you want to try and avoid by reducing your exposure, by perhaps putting in place some hedging. But the others, they're fairly transient events, so you don't need to worry about them too much. So the first period that I want to look at is 2008. And there's two ratios that I show pretty much every week that are the key things to watch. The first one is the NASDAQ composite versus the S&P. And this period here on your screen is from 2004 through to 2010. So it's a 6-year period of the ratio between the NASDAQ composite and the S&P. And when that ratio line is rising, that means that the NASDAQ is outperforming. It's going up quicker than the S&P. So you'll notice here in April of 2006, we got a significant turn down, and we'd already had one in the end of 2004, start of 2005. But certainly by April of 2006, this ratio turned over very sharply and went down until August of 2006. We then got a period where it then sort of stabilised versus the S&P, but this was the early warning sign, if you knew what to look for, that the character of the market was changing, that the market was moving a bit more defensively in terms of where the money flows were going. And if we line that up with what happened in 2008, so the index ratios were warning in April of 2006, and then also in November of 2007 and August of 2008. Now, the real damage done during the GFC crash was done in the latter half of 2008 into 2009. The other ratio that I look at all the time is XLY versus XLP, which is consumer discretionary versus consumer staples. And that was giving a loud and clear signal by October 07, and that is this ratio chart here. So this is the ratio chart. Now, again, when things are healthy, when sentiment is positive, when money flows are towards growth stocks, then this line is rising. And we can see that this ratio line stopped rising at the end of 2004 and started to go into decline and forming lower highs throughout 2005 and 2006. We started to get a breakdown in July of 2006, and we started forming lower lows. So all you needed to do was just observe that line, acknowledge that the character of the market was changing. Maybe it was going to be severe, maybe it wasn't, but at least that puts you on notice not to just keep ploughing on, buying more and more speculative stocks, as most people were doing during that period. You just basically pull your head in a bit. You acknowledge that something serious might be unfolding, and so you need to accommodate that. So it was very, very clear. And if we look at the worst of the GFC, the slide really started in August of 2008, and it didn't bottom until late February 2009. So we'd been getting, if you're observing what the charts are telling you, we'd been getting warnings for in excess of 2 years. Now, they were preliminary. They weren't something that you could really feel confident that there was some sort of disaster coming, but at least they should have had you on notice so that you shouldn't have been taken by surprise by what happened with the GFC, what unfolded in 2008. The NASDAQ composite peaked in October of 2007. So the early warning signs started nearly 18 months before that. The composite index peaked in October of 07 and then took 17 months to hit the bottom. So that was something that was well worth avoiding, and it could have been done very simply by just noting that there was a change of character going on in the market. And if you went a little bit defensive for a period, then that would have certainly saved you a fair amount of angst during that crash. Now, if we move forward to 2022, the market turned down, the NASDAQ comp turned down. So here is the end of 2021. So the market peaked in December of 2021 and it went down for 12 months. But there was some early warnings from these ratios, that NASDAQ versus the S&P and consumer discretionary versus consumer staples, that started to indicate some warnings from about February of 2021. So that's 9 months in advance. The ratios and the character of the market and the money flows had started changing. And then we got unmistakable confirmation in May of 2021. So let me just highlight that and show you what it looks like. And I've highlighted this ratio chart almost every week for years and years. So everyone should be very, very familiar. So here was the peak, the absolute peak in February of 2021. But of course, you couldn't possibly take any action on that because we don't know where it's going. But we started to get confirmation in the form of lower lows. We took out these lows through here in May of 2021. The peak didn't occur until November of 2021. So we had 6 months warning that the character of the market was changing. The money flows were changing. So it's just a matter of observing those changes, which I highlight virtually every week, and starting to adjust the way that you think about the market, adjust the way that you approach the market, and it can make a huge difference to your long-term investing returns. So that's the key message from today. Just go on and look at the way that we can do even better than the indices. So that's all at the index level, but of course, almost no one is trading the index. So how can we do even better than that? How can we gain a huge edge on the indices? And the answer is, and this might seem a little trite, but it's simply doing higher probability things. And it's a lot of people I speak to that don't actually, it's a very simple concept, but don't actually think about that aspect. What can I do that gives me a greater and greater edge? And there's many, many things, but such as be overweight founder-led businesses, because founder-led businesses tend to outperform the rest of the market, and by a very significant amount. And I've talked about that many times. Don't chase market darlings. Once something becomes flavour of the month, it's probably getting massively overvalued and therefore higher and higher risk. Wait for dips in highest quality stocks that have established momentum. So we're not trying to pick bottoms here. We're looking at stocks that already have the momentum. They've got very justifiable growth in price because the earnings are growing. And we wait for the periodic dip that comes along. We don't react to news events, which is a real killer because not always, but most of the time, the news is already priced in to a particular stock. So if you're reacting to particular news announcements, then you're way, way behind the 8 ball. So there are things that we can do to do even better on what the indices are doing. Now, last week we had a bit of a glitch with the video where it was just flashing backwards and forwards, which may have been a real distraction for some viewers. So immediately following that was the special offer, end of financial year offer that we made. Because of that interruption, and some people may have given up on the video thinking there was a problem with it, we're extending that offer again for 24 hours till midnight on Monday night. You might recall last week, the profit factor scoreboard was sitting at 2.82. Just in the space of 1 week, it moved up to 3, as you can see, for the combined US and Australian core portfolios. So it was an extremely strong week for those portfolios. So that's where we sit. That's the scoreboard. And for anyone that doesn't understand what profit factor is, the profit factor of 3 means that you are making $3 of profit for every $1 of loss. And that's a very strong track record over 2.5 years since January 2023. There'll be a link below this video, as I said, available until midnight on Monday, July 7. So just a quick recap on what you get The normal monthly membership is $249 a month. The first month only will be $149. And what you get within that service is access to well above average performance as per the previous slide, daily reports and recommendations, multiple video coverage, Sunday style messages about strategy, about plans, about perspective, but in far more detail than what you get in this Sunday video. And it's almost every day. And finally, and most importantly, significant email support so that you'll never be left wondering what it is that you should be doing with the market. And as I said before, there is a link below this video for anyone that wants to take advantage of that. The other point that I need to make, of course, is advising that you need to get your own investment and financial, legal, whatever advice that you need. This is general advice only. It's not taking account of your specific circumstances. So you do need to get the more wider investment advice. Let's look at America now. The S&P added 2.4 for the week, the NASDAQ 1.6. Two things really that spurred the American market. And it was a shortened week, 4-day week with Independence Day, but it closed on the highs. It was the trade deals, certainly helped sentiment. And also the June jobs report was significantly stronger than expected. Now, whether the market continues to cheer those numbers or not remains to be seen, because that certainly gives the Fed the ammunition to not cut rates. But it's a very fluid situation with Trump piling the pressure on Jeremy Powell. It's hard to know how things are going to unfold there. So that was the American market. The US dollar edged down below 97. The 10-year yield edged up a little bit from the 4.2s to the mid 4.3s. And the VIX also ticked up just a little bit and registered 17.5 at the close. So let's just quickly absorb those indices. So there's the S&P. As you can see, a very strong finish to the week. And just checking in on the money flow relative comparisons on a sector basis, there's the US market with technology clearly leading consumer discretionary. So the two predominant aggressive sectors, growth sectors of the market, and then followed by materials, finance, and energy sort of grouped there in the middle. But technology has clearly reasserted itself as the main driver of the US market. Now, if we look at it in Australia, XIJ, information technology, also continues to be the clear winner. Energy is still holding up, but that's certainly helped by a couple of things. We've got a spike in the oil price, and we've got this potential takeover of Santos. And then finance comes next. So they were the main indices for the week. Turning now to the Australian market. The Aussie dollar now, because the US has slipped, we're now trading above 65. But from my perspective, it's really US dollar weakness that is pushing it, because I can't see, given what's happening in the Australian economy, that there's anything else that would be pushing the Australian dollar strength other than the US weakness. Our index was up 1.1% for the week. Be interesting to see how it opens on Monday. And as I just showed, no change to the batting order in the sector. Precious metals, gold gained almost 2% to 3,335. Translate that to Australian dollars, we're about 5,100, so still very, very buoyant there. And silver had a good week, good finish to the week, and outperformed gold at the end of the week and has climbed back almost to 37. When we look at global stocks, and in particular GDX, the GDX version that's listed on the Australian market, it's up 47% since the breakout 11 months ago, and we'll look at that chart in a moment. So 47% up for GDX. And you've got to remember too, GDX, these are, whilst it's listed in Australia, these are not reflective of the Australian gold stock performance, because really the only significant holdings in GDX are Northern Star and Evolution Mining. So the GDX listed on the Australian market is hardly a reflection of what's going on with Australian gold miners. It's far more about the Newmonts and the Barricks and those sort of stocks, the ultra mega gold stocks. And over that period of time, just for comparison, the Australian dollar gold price was up 37% over that same period. So we're not really getting the leverage that we would normally expect to see. So let's go and look at some key charts. First of all, just look at the currency. So there's the DXY, that's the US dollar index. And you can see it's looking very, very sad there. So just for perspective, we've clearly broken key support, major support, and it's been in downtrend now. So that break of support occurred in April. We then had a little bit of a spike to the middle of May, but since then it's been very rapidly down, and there's really no sign of that easing off. Now we're down at a potential support level, but the way that this is falling, I would expect the odds are that the US dollar is going to continue to fall, and the Australian dollar, of course, heading in the opposite direction. Now let's dial in on silver and gold. So there's the silver price. We're back almost to 37 and back to the highs that we've seen a couple of times of late. And we've got to go back to 2011, August of 2011, to find higher prices. So clearly we've got to break out in silver, and you've got to say that the odds are that that will continue to the upside. That's not a guarantee. It's just, it's got existing momentum. And until that changes, then the probability is that it will continue to rise. There's the US dollar gold price finishing in the mid 3,300s. And in Australian dollars, not much change there. So we're still trading in Australian dollar terms at the same level as we were in April. So this is the Aussie listed index. And look, it's certainly a pretty strong trend, but there are many Australian gold stocks, both producers and developers, that have produced a return far in excess of this ETF. So there are certainly better alternatives out there. All right, so just to wrap it up, and the main point of this video is that the really big wealth-destroying events are pretty rare. There's really only been two significant events in the last 15 to 17 years where the impacts, in other words, the market indices going negative, have been beyond 3 to 6 months. There's only been two of them in 15 to 17 years. So they're very rare, and they come, as I demonstrated, with months of warning. Most people never know about them until they become a problem because they're just not watching the market closely enough, and they're not in a mindset where they can actually acknowledge what's going on. And that's why I do this Sunday video, and I've been doing it for 17 years, is to highlight things that are pretty simple and basic, but that most people just really live your life watching market ratios as I do. So most of those real wealth-destroying events come with plenty of warning. But if you're open-minded and you've got someone waving the flag for you, and you're open-minded, you're prepared to accept that things change on a cyclical basis, and you don't stress out about it too much, that's the killer. Anxiety and feel like you need to do something. Well, sometimes you just don't. The sudden ones, harder to avoid, the Trump tariffs, COVID, very, very difficult to avoid those, almost impossible to avoid those, because if you are able to react to those, then that means you're probably jumping at shadows. And you don't want to be doing that because you'll never allow the great stories to unfold. So the sudden ones, just don't stress about them. They're generally not lasting. They don't hurt too much. They might hurt for a month or two, but that's just a matter of how you think about the market. The nasty impact, and this is really the essence of the message today, the nasty impact is far more in our minds than in reality. And I think once you can cement that thought, then you'll be far better off as an investor. Portfolio analysts coming up this week, we're going to be doing some local tech stocks and a couple of other interesting things. So that's it for this week. There's more information on the website, and there's my email address, and I'll be back with you next Sunday. Cheers.